Did you know HEICO delivered around a 1,233% total shareholder return over the last 10 years? If you invested $10,000 in the S&P 500 10 years ago, you'd have roughly $43,000 today. If you put that same $10,000 into HEICO, you'd be sitting on about $133,800. HEICO has a market cap around $42 billion. Founded in 1957, it's a technology-driven company specializing in aerospace, defense, and electronics, and it has continuously operated in aerospace for more than 65 years. And here's another reason HEICO stays on investors' radar. Warren Buffett's Berkshire Hathaway recently increased its HEICO position by about 10% to roughly 1.3 million shares. So how did HEICO compound this way, and what is the business model behind it? Today, we'll break down what HEICO actually sells, why customers buy from them, what the financials are telling us, and what risks to watch. Air travel is growing, which increases aircraft usage and drives long-term demand for maintenance and replacement parts. On a typical day, the FAA guides 45,000 plus flights across U.S. airspace, and U.S. airlines alone operate about 27,000 commercial flights. Around 2.7 million people in the U.S. travel by air each day. Zooming out, in 2010, U.S. airlines had about 720 million passenger boardings a year. Recently, it's been around 983 million, roughly a 37% jump over about 15 years. HEICO has positioned itself to benefit from this surge by offering airlines cost-saving, FAA-approved replacement parts and services across a wide installed base of aircraft. HEICO is the world's largest independent manufacturer of FAA-approved jet engine and aircraft component replacement parts, other than the original equipment manufacturers and their subcontractors. An OEM is the original manufacturer, like the company that originally designed and sells the aircraft or engine parts. In short, HEICO manufactures FAA-approved replacement parts that are designed to be functionally equivalent to OEM parts, often at lower prices. Here's the easiest way to understand the value proposition. Imagine you own a Toyota and a part wears out. You could buy the original part from the dealership, or you could buy a high-quality certified aftermarket part that performs the same function for less money. In aviation, the same concept can reduce costs for airlines, but the standards are far stricter. Replacement parts must meet safety requirements and pass certification. HEICO's pitch is straightforward: functional equivalence, approved quality, and lower cost, and at fleet scale, the savings can be meaningful. And quick reminder, this video is for information and education only, not financial advice. If you're getting value so far, do hit the like button. It tells YouTube, yes, I enjoy learning about companies that compound over time. HEICO operates through two major segments, Flight Support Group, FSG, and Electronic Technologies Group, ETG. FSG accounts for over 60% of HEICO's sales. FSG uses proprietary technology to design and manufacture jet engine and aircraft component replacement parts for sale at lower prices than those manufactured by OEMs. These parts are approved by the FAA and are intended to be functional equivalents of parts sold by OEMs. FSG also supplies and integrates military aircraft parts and support services, primarily to the U.S. Department of Defense, defense prime contractors, and foreign military organizations allied with the U.S. To give you a sense of where these products and services can show up, HEICO's ecosystem includes major commercial aviation operators and logistics players, such as American Airlines, United Airlines, Lufthansa, British Airways, Japan Airlines, and cargo and logistics operators like FedEx and UPS, and it also supports defense and aerospace supply chains that include names like Lockheed Martin. ETG accounts for around 40% of HEICO's sales. ETG is HEICO's advanced electronics and mission systems side, supplying specialized electronic components and subsystems used in aviation, defense, space, medical, telecommunications, and other electronics markets. A meaningful portion of ETG's business is defense-related, including sales to U.S. and foreign military agencies, which can help stabilize results when commercial aviation cycles soften. ETG's customer landscape includes major aerospace and defense ecosystems and programs connected to organizations and primes such as NASA, SpaceX, Airbus, Boeing, and defense platforms associated with companies like General Dynamics, as well as space and satellite infrastructure ecosystems linked to firms such as Maxar. HEICO's competitive advantage is built around approvals, reliability, and long-term customer adoption. HEICO adds roughly 350 to 550 new PMA approvals per year. A PMA, or Parts Manufacturer Approval, is an FAA approval that allows a company to manufacture replacement parts for aircraft and engines. HEICO has developed approximately 20,000 parts for which PMAs have been received from the FAA. This is supported by long-term investment. The company grew FSG R&D from about $0.3 million in 1991 to about $36.7 million in 2024. And ETG R&D is about $74.5 million in 2024. Because aircraft parts are safety critical and approvals plus real-world performance histories matter, once a supplier is embedded, switching can be difficult, which supports the idea of a durable competitive position. That's why Morningstar rates HEICO as a narrow moat business, and Guru Focus scores HEICO's moat at 7 out of 10, what they describe as entry-level wide. HEICO didn't become a 1,000+ cent stock by accident. Management describes a consistent playbook over decades, internal growth plus acquisitions. Since 1990, HEICO has completed approximately 103 acquisitions. Management points out that net sales from continuing operations grew from about $26 million in fiscal 1990 to about $3.86 billion in fiscal 2024, representing a compound annual growth rate of roughly 16%. During the same period, net income rose from about $2 million to about $514 million, representing a compound annual growth rate of roughly 18%. Now, if the stock delivered over 1,000% total return over the last decade, that's roughly an 11x, or about 27% compounded annually. That's higher than the company's long-run 16-18% growth rates, but it can still align when you remember stock returns don't just reflect revenue and profit growth. It also reflects margin improvement, reinvestment quality, acquisitions, and sometimes investors paying a higher valuation multiple for a business that proves it can compound year after year. HEICO's auditors are Deloitte, and one critical audit matter highlighted relates to inventory in the flight support group. A critical audit matter does not mean the auditors found an issue. It signals an area that required more judgment and audit focus because it involves estimates. Inventory is also meaningful on the balance sheet. In 2024, HEICO reported about $1.177 billion of inventory out of about $7.59 billion total assets. So inventory is roughly 15.4% of total assets. HEICO's margins remain strong. Gross margin is stable around 39%. Operating margin is around 21%. But a major shift is visible in interest expense. Interest expense increased from about $6.4 million in 2022 to about $149 million in 2024, reflecting a change in capital structure after a major acquisition year. HEICO completed the acquisition of Wencor in August 2023 for $1.9 billion in cash plus $150 million in HEICO Class A stock, totaling about $2.5 billion. Cash flow shows 2023 as a transformational acquisition year, with acquisition activity financed by senior unsecured notes and a revolving credit facility. Then, 2024 looks like a digestion year. Operating cash flow increased from about $449 million in 2023 to about $614 million in 2024, showing that growth is converting into cash and the company used cash to reduce debt, visible in financing activities. Also worth noting, HEICO states no single customer accounted for 10% or more of sales in any of the last 3 fiscal years, supporting customer diversification. Finally, HEICO reports about 37% foreign sales, which introduces currency and geopolitical risk considerations. Over the last 10 years, HEICO's revenue has increased by roughly 324%, showing consistent expansion. Operating income has increased by roughly 319% over the same period. And one interesting point is how the segments behaved during COVID. FSG profits declined, but ETG helped stabilize overall profitability during that period, reinforcing the benefit of having both segments. Because HEICO has done so many acquisitions, Goodwill and Intangibles are large. In 2024, Goodwill is about $3.38 billion, intangibles are about $1.33 billion. Combined, that's around 62% of total assets. This matters because if an acquired business underperforms, impairment charges can hit earnings. 2024 shows an intangibles impairment of about $7.5 million, small but something to monitor over time. HEICO's 10-year total return is around 1,233%, far outperforming the S&P 500. On valuation, HEICO's PE has often been in the 50s to 60s post-COVID, and it has recently been around the 70s, which can imply the market is pricing in continued strong execution. Dividends have been increasing, but the yield is relatively low, meaning most shareholder returns have been driven by capital gains rather than income. 2 share classes. HEICO has 2 listed common stocks, HEI common stock, HEI.A Class A common stock. They are virtually identical except for voting. HEI equals 1 vote per share. HEI.A equals 1/10 vote per share. Long-term returns tend to track closely because the underlying business economics are similar, and the primary difference is voting power. Right now, HEI trades around $352, while Class A trades around $272, about 22.7% cheaper. So if an investor has no intention to vote, the Class A shares can be viewed as a discounted way to gain exposure to similar economics, and Berkshire's ownership being in Class A aligns with that idea. The long-term demand drivers remain supportive. Globally, airline passengers carried rose from about 2.67 billion in 2010 to about 4.3 billion, an increase of roughly 67%. And major airlines continue placing large aircraft orders, indicating confidence in long-term demand. For example, Qatar Airways announced new Boeing wide-body orders, including additional Boeing 777X aircraft, with its 777X backlog expanding toward nearly 100 aircraft. Saudia Group, including Saudia and Flyadeal, ordered 105 Airbus A320neo family aircraft. Emirates continued wide-body expansion, including additional Boeing 777X aircraft. Turkish Airlines has been reported to plan a large Airbus expansion order on the scale of around 220 aircraft. In the US, the FAA's baseline forecast expects passenger boardings to keep rising over the next 20 years, growing from about 984.1 million in 2024 to about 1,589.4 million by 2044. More flying means more maintenance and more replacement parts, a structural tailwind for the aftermarket. On the defense side, the U.S. National Defense Budget request for 2026 is about $1.01 trillion, described as a 13% increase from 2025, and plans discussed indicate a trajectory toward about $1.5 trillion by 2027. Increased defense spending can expand programs and sustainment work, which can benefit suppliers like HEICO. And finally, HEICO also highlights its long-term reliability track record. The company has stated that it has delivered 75+ million FAA-approved alternative parts over the decades, and that none have ever triggered a service bulletin, an airworthiness directive, or an in-flight shutdown. HEICO is a niche market leader in FAA-approved aircraft replacement parts and mission-critical electronics. It benefits from long-term growth in air travel, recurring maintenance demand, and a cost-saving value proposition that airlines and defense ecosystems can adopt at scale. The company has compounded through organic growth and acquisitions, but that also means investors should watch acquisition-related items like debt costs, goodwill and intangibles, and valuation levels. So the key question becomes, at today's price, are you paying a fair price for the quality of the business and its long-term compounding story? And if you got value from this breakdown, hit like. It really helps the channel. Subscribe if you want more undercovered, high-quality compounders. And comment below, what stock should I cover next? Should it be another aerospace name, a healthcare compounder, or something completely different? See you in the next one.